Please join us weekly for the 12th District with yours truly, Kerry Condata. Check your channel guide for times or go to ncwlife.com for details.
Welcome to another edition of Let's Learn here on the NCW Life channel. I'm Eric Grandstrom, your host, and we are delving into the world of taxes on a continuing series with the folks from Cordell Nairn Company, and certified public accountant Pete Luchini joins us again here on Let's Learn to learn more about our taxes. And today specifically, we're talking about next year's taxes, but
Right.
of course we're impacted by that here in 2018.
We are. We're going to talk a little bit about the personal impacts of the 2018 tax reform.
Okay, so we're in the process of getting 2017 taken care of. So the new tax laws, of course, kicked in December. They're passed in December, and now they're kicking in for 2018, so we got to worry about it come 2019 when we're filing.
Right.
So what kinds of things are the headlines from the new tax laws?
Well, I mean, there's actually quite a few, because this December tax law, the Tax Cuts and Jobs Act, is the biggest tax reform in over 30 years. So there's substantial changes for both businesses and individuals. And so I thought I'd talk a little bit about individuals, and all sorts of things have changed. Tax brackets have changed. The whole use of exemptions has gone away. The standard deduction has nearly doubled in most cases. So there's quite a lot of stuff that we can talk about.
Who works on that? I mean, you say it's the first real big tax reform in 30 years. So we hope that there's like CPAs like you working on this to help good old American.
Right, yeah, I'm sure all over the country. I think there was a joke in December, everybody's having a nice Christmas break except CPAs. And that is true to a certain extent. We were all very closely watching the legislation, and then because tax planning happens oftentimes in December. And so then we were all, as soon as the law came out, reading it as vigorously as we could, plus, reading different people's interpretations, because as with any law, there's always gray area and things that maybe perhaps weren't thought about when it was drafted.
So this giant reform that I assume it's about this tall, how big of a document is this if you were to actually print it all out?
I'm sure it's several hundreds of pages. But.
Okay. So to me as Joe Public, that means, well, okay, then I have no choice but hiring a CPA when I get ready for 2019.
Well, the answer, of course, I give this answer every time, is it depends. The joke was going on, oh, hey, now we're going to get to file on a postcard, and the reality is that's not the case anymore, or it never was the case. The simplification of taxes will occur for some people in certain tax brackets. For those people that have lost their exemptions and were not itemizing before, or had a limited amount of itemized deductions, the new standard deduction is going to take that place. And so the complexity of the preparation of their return is going to be much simpler. So for a number of people that will happen. For many others, people with businesses, small businesses especially, or people with expensive homes and those types of things, people who do continue to itemize, people subject to the alternative minimum tax, they will actually need a CPA probably even more so than they have in the past, because there's actual complexities to the law that are, I think, a little more challenging than they were before. And there's even been a fair amount of change to the depreciation schedules and everything. So.
Well, where usually one giveth, one taketh away. So if our standard deduction is greater, then what did we lose in the process? Or what are we getting dinged for in the process of having that available to us?
So we used to get a $4,050 exemption for every man, woman, and child on the return. So yourself, your spouse, your dependents. And that is completely eliminated. So for families, I have 6 children. This matters to me. That goes away, and then but the standard deduction will double. So if I'm not itemizing heavily, then my standard deduction goes up. It will be offset to a certain extent. It just depends on the situation. The other thing that has changed is the child tax credit has been doubled. So it used to be $1,000 per child, 16 and under 16. And if you were in I think about if you got made over 110,000, I think married filing jointly, that phased out, so you didn't get it anymore. Well, now it's a $2,000 child tax credit per child, and it doesn't start phasing out until about $400,000 worth of income.
Wow.
So that's substantial, and that I think is meant to kind of counterbalance people that had a higher number of exemptions.
Mm-hmm. Again, we're talking about 2018 here.
Right.
The 2018, the current year, so tax returns that we file for 2018 come 2019. So don't get confused that we're referring back to 2017.
Right. A lot of people have questions about how it's going to impact me and what it's going to look like. And so what I tell them generally is most people are going to be better off as far as dollars in their pocket. The withholding tables have been updated and changed. So I believe the IRS has put those out already, and they are to be implemented February 2018. And the exemption claims is different now, and they will get a little bit more back in their paycheck because we anticipate fewer taxes overall. The tax brackets has changed. There's still 7 brackets, just like there were before for individuals, but they've dropped a couple points in each of those bracket levels.
Well, that's all sounding pretty good so far.
Yeah, it is good. It's actually great for many people.
Okay.
So.
All right. Well, let's get into it. You mentioned easier.
Right.
Truly easier, or
For
I mean, they're
some.
trying to streamline it, right? I mean,
Right.
is the 1040 easy still around, or did
Yes.
the itemized 1040?
Yes.
We're still having to go with the forms.
Yeah, it's all very similar. They're adding a few lines for some new things, and they'll take out some lines. The domestic production activities deduction, if you had a small business that was eligible for that, that goes away in 2018. So if you're tax planning and you're factoring that in, you need to factor that out because it's gone. But in its place, one new thing is the qualified business deduction, and so the QBI, as they call it, qualified business income, will calculate a deduction, and that will go on your page 2 of your 1040. And so there's a lot of different things that kind of change the forms, but ultimately they're very similar to what they used to be.
Okay, that's a good introduction and a good place to pause here real quick, and then we'll kind of get into some of the bullet points for as we look at 2018 for the 2019 return. As we continue here on Tax Tips with Cordell Nair & Company and Pete Luchini, we'll come back in just a moment here on Let's Learn on the NCW Live channel.
Have a fun video you'd like to see featured on NCW Live? Email us at newsphotos@ncwlife.com.
Welcome back to Let's Learn here on the NCW Live channel. I'm Eric Granstrom, and I know nothing. So hopefully I'm like a lot of folks out there. That's why we turn to the experts to get more information, and we learn together here on Let's Learn. And today we continue our topic of taxes, which I'm horrible at. So that's why Pete Luchini is here from Cordell Nair & Company. Pete, thank you for joining me.
Yes, it's great to be here.
So we're talking about 2018 and the new tax laws that were passed at the end of 2017 and how they impact us as we look ahead and as we go and meander through our way. And hopefully, I guess the message too is that you're thinking about some of the moves you make pending on how that impacts your taxes
Right.
as we go through the year.
Right, exactly. There is some tax implications to some of the things that the law has changed. So state and local taxes are deductible still. We were thinking that that might have gone away, but they did salvage it, but they've limited it. So that's on your Schedule A. It's an itemized deduction. So any property tax that you pay or income tax, if you're in an income taxing state like Oregon, that's deductible. In Washington, it's sales tax. So most of us use a table scheduled amount. You can always save your receipts and add it all up if you spend a fair amount. Or on major purchases, if you buy a vehicle, you can add on that sales tax. And so that sales tax, that income tax, that property tax is all limited to $10,000. So for many,
Altogether?
yes.
Okay.
So you can't take a deduction for more than that $10,000. And for many people, that will be limiting. The good news is on that Schedule A itemized deductions that the P's limitation went away, and that was if you made over a certain amount of money, they limited your deductions so that you couldn't take as much of a deduction. That's gone, which is going to be fantastic for a number of people as well who do continue to itemize. The other thing on the Schedule A that will matter to a number of people is that the unreimbursed employee expense is subject to 2% of AGI. That means nothing to you, but if you think about transportation workers or construction industry workers who have to travel a significant amount for their job, and they have a tax home here, and their employer does not reimburse them for their meals or travel, then they can take that as an unreimbursed employee expense. And if they're out of town for 100 or more days a year, that starts to add up substantially, and it's been deductible for them, and that has gone away completely.
Oh.
Investment interest has gone away completely. So there's a number of things that go away that will hurt a certain segment of the population in the right brackets.
I've had an accountant take care of my taxes here for the past, I want to say, 2 years anyway. Prior to that, I did I think TurboTax 1 year, and I think I went to, I've gone various routes last several years. I've never done the tax forms directly on the IRS's site.
That's probably for the best.
Is it?
Yeah.
And that was the gist of my question too, is that they're trying to make it easier for us.
Well, we used to do them longhand, right?
Uh-huh.
We have very sophisticated computer software that sometimes will think better than we do. We have to know how to use the software, but yeah, it's pretty challenging. I mean, TurboTax is fine for the right person. Once you start getting any kind of complicated information, TurboTax might not suit your needs. And a CPA in our firm will help you with many aspects of your financial future, and so we're always looking to help our clients on their path to success.
Mm-hmm.
So,
well, let's talk about some of the things you kind of touched on, the tax brackets shifting a little bit for us. What's the dividing line now? Where are we at?
Oh, I couldn't even tell you where the tax brackets are. I think the 39.6 went to 37. I forget the rest. So they've dropped down a little bit.
There was a shift in a positive direction.
In a positive direction. Most people should be very happy with that.
Okay.
The other thing kind of related to that is the AMT. So AMT is the alternative minimum tax, and it was designed so that higher income people had to pay at least a minimum amount of tax, even if they were in preferred or they had a lot of deductions. It forces them to kind of pay some tax and share the burden. And it was pretty onerous. And this country's kind of known that AMT was broken for a long time. And so they had attempted in the past to kind of fix it, and this time they did make a substantial improvement to the AMT. They've increased the exemption amount, so there's a certain exemption amount that you have, and not only did they increase it, but they used to have it phased out at very low income levels, and now they've changed those to $500,000 for a single taxpayer and $1 million for a married filing joint. So many fewer people will not be hit with the AMT, which is it's a huge win for everybody.
So one thing I'm hearing, and again, I know nothing. I've already prefaced this, but it sounds like this is a lot of changes to benefit people that make a lot of money, and not so much I'm hearing that's going to affect a little guy like me in the middle.
I think it's
and
going to.
Of course, politically, that's the whole discourse about the guy you got in the head office right now.
Yeah, I mean, it's going to be proportional to a certain extent, right? I do think it will benefit most everybody, not everybody. There's just going to be certain situations that don't fit into that situation, but I do think it will be a proportional, right? The more you make, the more savings you will have. Mm-hmm. So, I can't really speak to what politics relate to that.
Okay, all right. You have SALT. Thankfully, she's provided me with those here of questions. Yes, what is SALT?
So that was what I was talking about when I said state and local taxes.
Oh, okay.
Yeah,
okay.
So we're good there.
Okay, all right.
The other question that I get asked a lot is about the health insurance mandate, because there's kind of I've heard a couple different things about what happened. They got rid of it, they didn't get rid of it. Well, actually the mandate that you have health insurance is still required. So that has not gone away. What has happened is that the shared responsibility payment can no longer be assessed to you in 2019 or later. So for 2017, if you didn't have health insurance, you pay a penalty on your tax return.
Right.
It's called the shared responsibility payment. 2018, same thing as well. In 2019, if you don't have health insurance, there's no way they can they don't charge you a tax anymore.
Which is what, about a $900 fine?
It actually also
taxes?
depends on your, your
Income
relationship
level.
to your income level in relation to the poverty level and the number of dependents. So I've seen repayments as high as, I don't know, a couple $1,000s.
I've heard of people, and we're referring to 2017 here, or 2016 actually. I heard somebody, or I've actually heard a few people that have argued about that penalty that they would face and have gotten out of having to pay that penalty because of their circumstances as far as their being a entrepreneur, being a private business person and things like that, and the cost prohibitive nature of insurance as proposed to the fine they would have to pay, and they've actually not had to pay that, whatever that fee was.
I would say I'm not surprised because my experience in IRS collections is that while the penalty can be assessed, the IRS cannot they cannot seize the assets or collect it. They can send you a bill, but if you don't pay it, there's nothing they can do. They have no recourse to go and get it.
In that particular instance.
If you overpay your taxes, they can take it out of what would have been your refund. But if you have underpaid your taxes, they can't come and get it. So it was kind of one of the maybe perhaps flaws of the original law that there was no teeth in collection for that penalty.
Okay. All
So,
right.
yeah, interesting. Yeah.
All right, we need to take a quick break here and come back. We're talking tax tips with Pete here from Cordell Nair & Company. We're going to take a break and come back next on Let's Learn on the NCW Life channel.
For all the latest news in North Central Washington, go to ncwlife.com or find us on Facebook. Got a news tip? Email us at news@ncwlife.com or call 888-2020.
Welcome back to Let's Learn here on the NCW Life channel as we continue our tax tips series with Cordell Nair & Company and CPA Pete Luchini talking about individual impacts for 2018 for the 2019 return. And Pete, we're delving into specifics here. Looking at the relationship not working out, looking at a divorce come 2018.
So actually this is one of the most substantial changes in the law. They have now said in the past alimony paid was deductible by the person paying the alimony, and alimony received was then taxed as income. And for divorces that occur after December 31st, 2018, that will go away. So alimony paid will not be deducted by the person paying it, and alimony received will not be counted as income by the person receiving it.
Interesting.
Yeah,
that's pretty big.
It's a big deal. It's going to have a huge impact on...
That's across the board? That's no matter how much is being paid or received?
Yeah,
wow.
And so the real learning thing from that is that if you are planning to divorce, do so before December 31st, 2018, because you can still, it grandfathers in all the other prior divorces. So alimony paid and received will still get that same old tax treatment. But for divorces finalized after December 31st of 18, that is a substantial impact. It's going to send family law lawyers scrambling as far as how to equalize or normalize the financial consequences of alimony.
Yeah, they'll start talking about property and house and things like that.
Right.
Yeah, absolutely.
Yeah.
Speaking of house, mortgage interest rates and things like that, what are we looking at for this year as we get ready for next year?
So this will really generally affect people who are buying houses now and in the future going forward, and that is expensive houses. So people who are in very high-cost locales, because the mortgage interest deduction, it used to be that you could only deduct interest on the itemized deduction Schedule A if your mortgage was for less than $1 million, and now they've lowered that to $750,000. So, but it's for new mortgages. So if you get a new mortgage going forward, new debt, and it's greater than $750,000, it's going to be limited. So the interest you pay on that other $250,000 now is not going to be tax deductible.
So if you're looking at buying an expensive house, do it before the end of 2018.
Well, that's actually as of 2018. So you would have had to have done it in 2017.
Okay.
So
Missed
yeah.
that. See, that's why you got to be in touch with your
Right, we
CPA
do.
throughout the year to say, hey, you might think about this.
But we only knew about it on December 22nd, so that's a small
Oh,
window of
yeah.
time to go out and buy $1 million
that big rush
home.
of calling
Yeah.
up and saying, hey, Pete,
Right.
what does this mean?
Right.
You mentioned a little bit, we touched on the savings accounts, your 401k and things like that.
Right.
Where are we as we step into the new year on that?
Well, they actually were going to change some of the 401k provisions and retirement provisions, but they got a lot of pushback from every direction, so they left that alone, which is great news. But what they did do is for 529 accounts, which is the account that you would fund for a minor child to pay for their college education, you fund it with post-tax dollars, meaning you pay tax on it, but the income, you invested it, grows tax-free, and you take all the money out, and the growth part is never taxed so long as you use it on qualified higher education. Well, it has traditionally always been higher education, which can be any number of things. It can be trade school as well as a 4-year degree or a 2-year school. But what they've done now is they're allowing people to use up to $10,000 per year out of that account for primary and secondary education. So if you want to pay for your kid to go to private school, first grade, then you can now take some money out of that 529 account.
And not be penalized for that.
That's right.
Okay, that's fantastic. We're quickly running out of time here, so I wanted to get to some of the larger items of interest here, and maybe you could talk
I'll just go
on
over a
what we
few.
need to hit on here before we're done.
For people who have done a lot of moving in the past, we're a much more transient nation than we used to be. Moving expense used to be deductible. It is no longer deductible. If you are a member of the military, you still get to take some moving expense deduction in excess of whatever the military covers. So that's kind of a shame. The disaster deduction, we used to be able to take casualty losses if our house burned down and the insurance didn't pay for all of it. Well, now you have to be in a declared disaster area in order to do that. On the really upside is the estate tax exemption has doubled. So it used to be a little over $5 million per person. Now it's like $10.98 million per person.
Oh, wow.
So for a married couple, up to $20 million or a little over $20 million of their estate can be excluded from the estate tax. So they can pass on a substantially higher amount to their heirs now.
And that's been something that's been fought about for quite a while now.
A long time, yep. And there was times when it was a very low number. So $5 million was good for quite a while. And then I just wanted to cover a few other things that people had questions about things that are staying the same. Student loan interest is still deductible, so that's kind of nice. They talked about getting rid of that, but they didn't. It's up to $2,500. So it doesn't really help physicians who are paying off those high medical student loans, but medical expenses, which is an itemized deduction, it had been 10% for most of us. Over a certain age, you could get a 7.5% deduction, which means that any dollar over 7.5% of your AGI that you have spent on medical expenses was deductible. And so they actually lowered it from 10% to the 7.5% for everybody. So that stays, and we still have that, and that's great. Teachers still get the above the line $250 deduction. I don't know any teacher that doesn't spend at least $250 on their classroom. It's only for K-12 teachers, so you have to be one of those to qualify. And then another one that was kind of on the chopping block was the exclusion of gain on your personal residence. So if you sold your home and you sold it at a substantial gain, if you had lived there for 2 of the last 5 years, then you could exclude up to $500,000 of the gain if you're a married couple. That they were going to change it to, I think, a 5 out of 7. I don't know. They were going to make it more challenging, and they didn't. So that's fantastic news for us. And you know, there's a new child tax credit for a non-child dependent. So it could be someone else who is a dependent that doesn't qualify. That would be, you know, or for example, your 17-year-olds, and I believe it's $500.
Okay. All right. So that's staying the same, at least for
that's
the
new,
next year.
but yeah.
Okay.
So,
all right.
lots of good stuff.
If folks have more questions and they look at this stack of new laws for 2018,
right,
and they want to talk to you or somebody at your office, how do they get a hold of you?
663-1661.
Okay. She's Pete Luchini, CPA with Cordell Nair & Company. And this is Let's Learn as we continue our tax tips here on the NCW Life channel. For more, head to our website, ncwlife.com.
Are you wanting high-speed internet but don't have access to PUD fiber? Try Sky-Fi high-speed wireless internet from LocalTel. Call 888-8888 today.